Okay, back to the state of macro for a while, and then some stats on money itself. So can there be an alternative to the neoclassical stuff? Well, if you look at what I've shown you with behavioural and fractal and inefficient markets hypothesis, they're all more consistent with the data than EMH is. And they argue that agents aren't rational the way neoclassicals define it, which of course means basically capable of predicting the future accurately. Of course, you then can't combine, you can't separate the two, so you need to combine economics and finance. And a lot of people think, well, that means we've got to work from irrational agents or bounded rationality and work up from that level rather than presuming agents can actually foresee the future completely. Now, I think this isn't the right way to go, to start with building an alternative, because it's starting from the belief that you must model the macroeconomy from the level of agents up. But why not model it from the level of the entire economy down? Why not turn it upside down and do it that way? Because in any situation, whether you have rational agents, we have to use absurd conditions to aggregate, or even bounded rationality, it works out to be really hard to do the aggregation. That's what the reason that they have this nonsense assumption of the rational agent is that it's the only way they can do aggregation. Okay? Now, if you say there's irrational behaviour or bounded rationality, then that implies you can model the economy using limited cognition agents. And there are people who do that. So a couple of good friends of mine, Paul Omerod does a lot of work on modelling interacting agents in a company called Volterra. He's one of the leading English non-neoclassical economists. And Leanne Usher is actually an Australian, now living in New York, models financial markets in particular using what she calls zero intelligence agents. Actually not limited cognition, no cognition whatsoever. And what she's really arguing is they behave randomly, and it's the structure of the finance markets into which they operate that determines what happens in the markets more so than what agents themselves do. So you can do it that way. But there's also another way, which involves not using agents at all. And this is how a lot of sciences behave. Economics not being a science. They start from the top level down, like in biology. You don't model at the level of individual agents, which would be, ants and rats and stuff, and build up, though people are now doing that. But predator-prey models, for example, began at the level of population. So you start with an equation for the population growth of a particular species, and then you see how that interacts with another species. You're not talking about individual agents. So they began at the level of an overall population, have equations for the population in total, and then see how they interact. Now, this is showing you one of those done in what used to be my favorite program for modeling systems, VisSim. I'm now getting a new program written by a colleague of mine, Russell Standish, using an INET grant, and this is the program you guys are going to be getting to use in the next week or so in the course itself. So what I've got here is a model of fish populations, and this is an integration function here. So what it's saying is the number of fish is equal to the fish you've got now times the growth rate, integrated over time, minus what happens when fish interact with sharks. And there's going to be a probability of being eaten by a shark. So you have, that'd be straight exponential growth if I didn't have this bit. And having this bit here, I've then got the interaction effect of being eaten by a shark. Down here I've got sharks who will die if they don't get to eat fish. So there's a death rate for sharks in the absence of fish. Of course, they'd be eating each other there, and we know that sharks do eat each other. You seen that stuff about what they call, what's the fish, the Port Jackson shark? You seen those? You want to tell us a story about that? What it was that when the female gives birth, they're actually born alive inside the womb. There's about, it's like 10 or 20 or 30 born at 21, and they eat each other in the womb, and only one comes out alive. That's what I call one vicious way to get born. So they'd eat each other if they weren't fish to eat, so they decline. But here I've got them interacting. If they eat a fish, then there's odds of improving their survival. So this is a model of interacting populations. Watch what happens when I simulate it. This is going to show you the number of fish. That's going to show you the number of sharks. And this shows you the population of fish and sharks at a particular point in time mapped against each other. This is what you get. You get cycles. Okay. Now that's actually, the model was built to explain data that showed cycles, the number of fish and sharks being captured by Italian fishermen off the coast of Naples, I think, during the war period, because there was a change in the number of fish and sharks turning up in the population in the catches, which was related to the number of fishermen who had to go off and fight in the First World War. So this model was built to explain empirical regularity of seeing cycles, the number of fish and sharks being captured by fishermen over time. So that's what other real sciences do. So they look at the population rather than agents, and I think being obsessed with agents and working up an individual may be a major reason why we haven't actually got to understand the economy as a complex system as it actually is. And the structure of the economy and the interactions between agents may be more important than the actual behaviour of the agents themselves. Look at the thing I showed you with the Sonnenschein Mandel-Debreu conditions. If you have two agents in isolation, you can derive nice downward sloping Hicksian compensated demand curves for them. As soon as you treat them as being an economy where relative prices change as a distribution of income, you can't derive a demand curve for them at all. So the relationship matters more than the definition of the individuals. And that's a common thing in a lot of sciences. What emerges out of the relationship between entities is more of a way of defining what the system itself does than the behaviour of the isolated entities themselves. It's called emergent properties. So we may actually be better off working from the top down. That's what I'm going to take you through when I model. So swapping from optimizing agents to satisficers may be the wrong way to go. There's an initial start. The right way may be to go, let's look at the overall population, social classes, top down, and so on. So that's what I'm going to be doing later. And maybe you bring in agent-based later. But the essential thing you should be trying to do is to replicate the data. To get a model which behaves like the way the economy itself appears to behave, and also over the very long term, not short enough so you're affected by a particular set of policy conditions or a particular trend in debt levels, etc., etc. You want to be right for the very long term in a qualitative sense, and then you know you've got a model which is at least a reasonable simulacrum of capitalism itself. You've got to know what the data tells you, and one of the interesting studies was actually done by two of these arch-reactionary neoclassical economists. These guys got the Nobel Prize jointly for developing real business cycle theory. But in 1990, they did a really, really good piece of empirical work where they said, let's just take a look at the data. And what did they find? Well, they found a whole range of things that don't fit these conventional beliefs that the money supply is exogenous, because were the money supply exogenous, then changes in the stock of money should either have no effect on the real economy at all, just cause inflation, or they should be, they should be changes which occur before movements in price variables, or if they do affect upwards, variables before that. So the causation should run predominantly from change in money supply to change in prices, okay? And the government's behaviour should occur before you see the reaction to the private sector. So they looked at the timing of economic variables to work out what's going on, because if you find that every last time a particular variable Y follows another one in time, then you can't say Y causes the one that comes before it. Okay? If there's complex causation, then the sequence of events can change over time between things involved in a positive feedback loop. One can cause the other. Okay? So you can get reversals happening there, but if it's always the case that if the neoclassical theory is right, then it should always be the case that changes in the government stock of money should precede changes in the rate of inflation. And, should they be uncorrelated or correlated and leading them rather than lagging them? This is the main conclusion they reached in terms of looking at monetary theory. There's no evidence that the monetary base leads the cycle. Okay? Both of them are generally pro-cyclical, and the monetary base lags the cycle. Okay? So they're showing, in effect, that the money supply at M0, base money, is endogenous, somehow determined within the economy, even though it's supposed to be under control of the government. That's quite a non-neoclassical conclusion from this research. What they were trying to do was just look at the data and work out what it shows you. And they made the very good point that lots of sciences just go and see what the data is without having a theory beforehand. But at the same time, the models they looked at were determined by neoclassical growth theory, because a theory will always indicate to you what you should look at. For example, before Einstein came along, nobody would have bothered checking to see where the light bent around the sun, because light travels in straight lines. But Einstein comes along and says gravity can bend light. So therefore, Eddington, I think it is, goes and does the experiment, going out and seeing what happens with, I think, maybe the transit of Venus at the time, and seeing how the light is affected. Or I think it was the sun going past a particular star, and then measuring whether the light from that star was bent around the sun or not, and whether if it was bent, did it work out to be precisely what the general theory of relativity said it should be, which was the case it did. So the experiment itself was only done because the theory said you should look at this effect. So theory does tell you what data to select. But they said apart from that, you should still see whether the statistics fit the theory. So they didn't look, for example, at the ratio of debt to GDP, because according to their theory, that shouldn't have any impact. So it's not part of what they analysed. If I did this research, I'd be looking at debt to GDP as an essential element. So they said, looking at the business cycle facts using established theory, do the stats display the pattern found that the model predicts? And it said, we find these features interesting because the patterns they seem to display are inconsistent with the theory. Now, if you found a result like that in a genuine science, you'd go off trying to find a theory that did fit the facts. But these buggers didn't. Find all sorts of conclusions they reached, which if they'd followed the conclusions, you would have had a decent macroeconomics coming out of it. They didn't bother doing any of what they said the data says you should do. So they began with a very simple definition of cycles, saying cycles are just deviation from trend. And what they did was they worked out a way of actually defining the trend using the data and then subtracting the trend from the data to get cycles. So their definition, they also criticised causal definitions, and I find this quite a hilarious argument here, typical of their attitude. They said most theories used to explain what happened in a boom by the slump beforehand, so a slump causes a boom and so on. The sort of stuff I'll be taking you through with Minsky in the next couple of lectures. They said that these theories have failed. Theories that say there's some causal deterministic process behind the cycle have failed. And why have they failed? Because they don't arise as equilibrium behaviour, probably a word again, for economics, not economies, so economic theory, with empirically reasonable preferences and technologies. That is, for theories with statements about people's ability and willingness to substitute. In other words, you can't get deterministic cycles out of our theory of how the economy operates. Therefore, theories with deterministic cycles are bad. That's nonsense. If you wanted to invalidate a theory, you've got to invalidate it against the data, not the fact that it doesn't fit another theory. Okay? The contest ultimately comes down to who fits the data better, which is what Friedman argues, but they again bastardize this way of thinking. So they're saying they're rejecting the causal cycles on the basis you can't get a causal cycle if you have optimizing agents. Well, big deal. So this is a nonsense reason to reject deterministic theories. So forget that particular part of their paper. What they did in the paper, they took a range of data, GDP, consumption, income, labour income, and so on, and monetary variables, and they took the logs and then they looked at the change in the log, because as you all know, that simple little relationship that the differential of the log of a function is the percentage rate of change of the function with respect to time. You get the slope of it multiplied by 1 over the current value, that gives you the percentage rate of change. So just working out percentage rate of changes using logs. So, and then what they tried to do is to find a vector of values that minimize this function. Yeah, I know, a bit of a horror. Let's take a look at it. That's the value of the variable. That might be output or investment or wages and so on. That's an estimated trend rate of growth where if there's 40 years of data in its quarterly data, there'll be 160 observations in each, say, starting from 1950 through to 1990, that sort of thing. So the YT is the actual value, and the tau T is your estimate of the trend. Now here's this thing here, lambda is an arbitrary weighting factor between two halves of the equation. The first half emphasizes the long-run trend. So if your long-run trend is going to be a smooth thing, of course, okay, relatively smooth. So if you happen to be your economy is growing precisely on trend at all times, the sum of that summation would be 0. So you're trying to minimize the overall function, trying to get that as close to 0 as you can. But at the same time, you want to fit the cycles. So there'll be times when you're going to be above and below the trend. So this particular part here emphasises the short run fit. And what that actually basically, as you take a look at it, is being the tau at one time ahead, divided minus tau plus the tau at the other time behind squared. Okay, because the tau t cancels out of that expression. So the value you get out of this is taking account of both the trend of something growing over time and the fluctuations around it. And it gives you a trend rate of growth. And you then subtract that from the actual values, and you've got the cycle according to their definition. Then you compare them using regression analysis, and you shift them around in time so you see what leads and what lags. That's what the paper basically does. So illustrated graphically, I'm using a very simple definition of trend here. I'm taking raw data and then take the logs of that raw data. So that, just go back again a bit fast there. That's the actual nominal GDP of America from 1959 to 1999, so 40 years of data, so 160 observations, starting way down here, ending up at about $10 trillion, 10,000. Now that's 10 to the 4, so taking the logs, you get 4 at the top here, of the logs, and that's therefore showing you the straight line, roughly straight line. If it was perfectly straight, there'd be smooth growth, so it's clearly cyclical data to some extent. So once you've done that, you then, having got that log, you then derive a trend line from it. And I'm just using a 4-year moving average as a simple illustration you could reproduce in Excel. Subtract one from the other, and you get the cycle component. Okay, so that's the basics. That's how they drive the idea of the cycles in the log of US GDP growth over time. Now you do the same thing with investment. So there's your fixed investment, actual nominal value. There's the moving average imposed on it. There's the difference between the two. And now you've got the apparently cyclical component that you want to, of investment, fixed investment that you want to compare to GDP. Then you overlay the two and notice how much more volatile investment is than GDP. Okay. And then you work out, moving it forwards and backwards, you work out which lags and which leads. That's the basic idea of the paper. So they found a range of conclusions here that didn't fit conventional theory. So for a start, they said the real wage behaves in a reasonably strong pro-cyclical manner, which means the real wage rises during a boom and falls during a slump, which is counter to a widely held belief in the literature. Now, why would they believe that the real wage would fall in a boom and rise in a slump, which would be counter-cyclical? Any idea? What part of neoclassical theory did reach you to believe that real wages should fall during a boom? Any idea? Go back to your production function, the idea of a diminishing marginal productivity. You've got output on the vertical axis and labour input on the horizontal, and you argue diminishing marginal productivity. So the function gives you a diminishing amount of output, more output per unit of labour, but at a diminishing rate. So the slope's getting flatter. Now that is the marginal product of labour. And in the way they have theorised about the labour market is that wages are set in a competitive market, so the price of labour is equal to the marginal product of labour. Okay, supply curve, you get a horizontal demand curve set at the marginal product of labour, a rising labour supply curve, you've got to pay a higher wage to get the labour. So if you want to get, if the marginal product is falling, then the wage will fall. So during a boom, the real wage of labour should fall. In fact, that's the opposite of what they found in the data. They found the real wage rose during a boom. And that sounds more realistic, doesn't it? Outside economic theory, you'd expect workers to get a higher wage in real terms if there's a boom going on. Okay? But it runs counter to neoclassical belief. Now they found, again, as I mentioned here, the volatility of investment, which is sort of more Keynesian. And this is the key one. The monetary base lags the cycle rather than leading it. And so does M1. Now, this key point is here. They say that when you take a look at the difference between M1 and M2, you've got pure credit money surely created just by the private sector. And they say the difference of M2 minus M1 leads the cycle by about 3/4. So what you've got is changes in credit money precede the cycle and changes in government money follow the cycle. Now, that's the opposite of the money multiplier argument. They also found that the money velocity was pro-cyclical and very volatile. Now that again goes against Milton Friedman's attempt to show that velocity was stable, which is an essential part of the quantity theory of money. So you get M2 leading the cycle and M1 lagging it. Well, in that case, how can M0 cause M2? Which is the conventional money multiplier case. So the results they're getting support a non-neoclassical perspective on money. And here they say it quite strongly. And they conclude, and this is very, very sensible stuff, that credit arrangements could play a significant role in future business cycle theory. And introducing money and credit in a way that accounts for the cyclical behaviour of monetary as well as real aggregates is an important open question or problem in economics. That's true, but they didn't do it. Despite these findings, they should really have gone and said, okay, we need to build a theory where credit plays an essential role, but they didn't do it. Instead, they had the model, the real business cycle models and most ESG models until recently, with no role for banks, credit, or debt. And they've got this pro-cyclical and volatile velocity, which again goes against the arguments of a stable velocity, which you need for the quantity theory of money. So you get they're not supporting that broad money is controlled by base money. They're not supporting that B is stable. They're arguing that high unemployment doesn't actually lead to high price inflation. And they're arguing that the distribution of income, when you take a look at it as well, plays a role in the trade cycle. And the credit's essential. All very sensible, non-neoclassical conclusions. So money in that case has to be endogenous rather than exogenous. It has to interact with the real economy rather than being separate from it. And the causation of where money comes from is the reverse of the conventional argument. Now that's the causation you'll find in post-Keynesian literature. So if you had exposure to Basil Moore through courses with Margaret and Neil and Bill and so on, then that's the causal process. That Basil was the person who first put it in a very serious way, though you can find it back in Schumpeter back in the 1930s. The argument that money is created by the private sector and the government responds to what the private sector does rather than the other way around. So Basil's an interesting guy. He's actually known as a US post-Keynesian economist, but he's born in Canada, currently lives in South Africa, but he did most of his work at Wesleyan University and is regarded as a US post-Keynesian. And he criticised ISLM before Hicks did. So if you take a look at his argument, he said that rather than the central bank controlling the money supply, the central bank accommodates to what the private sector wants in the way of money. And he was focusing on the mechanics that applied back in the 70s, which unfortunately no longer do apply as much, that large corporations largely finance their day-to-day expenditure using lines of credit. Now what's actually happened since then is that wasn't particularly profitable for the banks. So they've actually almost ceased providing it. They charged so much for a line of credit that most firms couldn't be bothered doing it. And what instead most firms have done in the modern day is issue what's called commercial paper, where they will sell a bond with a lifetime of 1 week or as much, no more than 90 days, get money for that and then pay their wages and expenses out of that, which is why the collapse of Lehman Brothers was so disastrous, because they'd actually pretty much cornered the market for commercial paper. So when Lehman failed, so did the market for commercial paper. And that's why you had such a sudden shock to the American economy. Now, of course, when they let Lehman fail, most of the characters who did that didn't actually realise that's what Lehman had specialised in. They had no idea what would happen when they shut it down, because suddenly the money supply of the whole American economy stopped. So that's why it was such a huge crash. But back when Basil wrote this paper, most companies finance themselves using lines of credit, and they're a bit like your credit cards. You and I, you will get an offer of a credit card, $10,000 limit, $5,000 limit, $25,000, related to your income. And that means you can go shopping. If you have, let's say you've got a $5,000 limit on your card, and you've got $1,000 outstanding, and you see a really good deal on a second-hand motorbike somewhere, then you can go along and swipe the card at the motorbike dealer, give them and what happens with that swiping is you create $4,000 worth of money that turns up in the account for the bloke selling you the motorbike, and you create a matching $4,000 debt for yourself at the same time. And there's no way the bank can stop you from doing that. If you've got the headroom, then they're required to honour that increase in the money supply. Well, the same thing used to apply with lines of credit. And the argument that Basel made at the time was that firms have negotiated this so they could expand their expenditure whenever they needed to. And one of the main times they'd need to do that is when there was a wage settlement. We're talking back in the days when inflation was running at over 10% on occasions, up to 17%. So what would happen is there'd be a new wage agreement reached. You'd have to pay 10% more for wages the day after than the day before. You simply accessed your line of credit. By accessing the line of credit, you actually created additional money. And you created an additional debt for yourself, of course. So he says, therefore, what happens is rather than growth in money causing wages to rise, which is the monetarist argument, the other way around. The growth in wages caused the money stock to rise. So it reverses the causation inherent in the quantity equation. And here's Basel writing about it. Changes in wages and employment largely determine the demand for bank loans, which in turn determine the rate of growth of the money stock. And central banks have to accept this. And all they can do is vary the short-term rate of interest. They could, change the rate of interest being charged, which was happening under the Volcker regime to try to control that. But he said they can't stop the actual creation of credit. They can make it more expensive, which is what Volcker did, and ultimately broke the inflation in the 80s period. But they are reacting to what's happening in the commercial system. They can't control the money growth. So he says the supply and demand of money and credit is determined by the demand for it. There is no independent supply curve. That's fairly much Basel's proposition. So the state can affect the price of credit, but they can't control the volume being created. Now, Basel argued that conventional theory began from the belief that money was gold and coin at one stage. Now, this appears to be a creation myth, by the way. If you look at the work of Michael Hudson and David Graeber, who were talking about early anthropological research into where money came from, they will argue. There's also a very good book I've started reading called, what's it called? The Double Entry or something of that nature. It's written by an Australian academic in Melbourne who's done some more very good work as well on where money and credit first came from. Well worth the read. I'll have to look up the name later, but very, very good book. And so they argue that credit actually preceded money. We began in small communities, like this room is like a very small Cro-Magnon tribe. What actually would happen in the tribe is we'd all be doing stuff collectively, and one of us was a good fisher person, another person was a good maker of tools, somebody else could cook really well. Then what would happen is we'd make mutual gifts to each other. And implicitly keeping track of, so-and-so gave me this great, fish, I should really respond to I'd like to make them a nice, new flint knife, etc., etc. So there's a sense of credit there. And of course, if you had people who never reciprocated, they'd often get, excluded from the tribe and have to break away and form their own group or whatever. So credit was a mutual obligation thing, part of what actually bonded the community together. Once you got past about 150 people, that starts to break down, and ultimately you institutionalize that in the religious institutions. You all had a collective belief and a mythology about how the world came into being. And so the church, whatever that might have been, we're talking pagan religions, obviously, that became the focus through which those credit obligations were now collected, because even though 150 people could keep track of what their obligations were to another, 150 people in the same group, once it got beyond that side, just too hard, but they all trusted the church. Okay, so the church and state were combined in those early ways, and the credit books that the church institutions kept really preceded money. Money only came about with gold and silver when there was social breakdown, and there's no longer anybody you trusted, so you want to have an external object that you could actually treat as money. But the neoclassical creation myth is that money began as gold and silver coin, and credit money came along later. And Basel's argument was they applied the logic which would apply if you used a commodity to modern money, which is where it doesn't work. So people who look at endogenous money theory, first of all, went back in time to when the Lombard families and the great trading families of Venice in particular invented double entry bookkeeping, and also had played the role of collecting the coins and the gold coins, which were being used at this time of social breakdown. Because they were so well trusted, you could actually issue a certificate payable on one of these houses, and people would accept that as being just as good as getting the gold itself. And you reinvented credit effectively when it became down to IOUs, because you could actually say this is gold of Vincenti Fonseca or bearer, and then Vincenti Fonseca could sign this over, and it would then be taken. The bearer could then take it and they check signature. Yes, this is Vincenti's signature. Therefore, this is now a valid tradable object. They didn't actually need to have the gold. So you, in effect, reinvented credit with double entry bookkeeping. Now, that therefore means the approach that neoclassicals have had is still treating money as a commodity when there's a fixed amount of it, the loanable funds type model, when in fact it's very, very, very different when it can be created by double entry bookkeeping. So if you have a commodity, then the hoard plus the new output is all there is. And that's the way neoclassicals treat the economy, as though there's an independent supply function, mines producing gold and silver. Well, that's feasible, but it's not what we actually use. Okay? We're not using the commodity money, we're using credit as money. So when you have a commodity money, like gold and silver, imagine when Cortez invaded Mexico and sacks the Aztecs temples to get the gold. Once you've got the gold, then gold's an asset in the hand of the person who's got it. It doesn't involve a liability to anybody else. But when you think about credit money, if you have credit money as of your credit card, yes, you can create money by doing it, so you've got access to money effectively, but you also get a liability out of it. So there's a role in which you've got to look at the role of assets and liabilities together. And as I've shown with the example of you going shopping for a motorbike, that a stock of bank money is determined by demand for credit. If you actually are willing to go and take on the extra debt, then you create the extra money. Okay, so the demand determines the supply. So that gets us back to some of the elements of conventional theory, like the quantity equation, what happens to it? Because it's basically a truism. When you write the equation down, you've got three givens. You've got the price level, the level of output, real output, and the money stock. Those three together determine what V is. It's just a ratio. Now, if you have the exogenous money case, Friedman argued that V was stable, and a huge part of Friedman's research project over his lifetime was to prove the stability of V. Well, he didn't. He thought he did in the monetary history of the United States, but plenty of research has shown no, V is quite volatile. That's why I used the example of the Kydland and Prescott paper. Now, that's what the endogenous money people argue as well. V is quite volatile. It'll rise and fall in the trade cycle. So if you have a boom going on, V will get higher, the more transactions for a given stock of money. During a slump, it'll fall, and that's what's happening up right now. We can see it quite strongly. So it's flexible. It's not a fixed equation for a start. And then it works backwards because, as Basil argued, if there's an increase in wages, that causes the money supply to rise. That's the mechanism. So it's in reverse. Rather than M and changes in M causing changes in P, changes in P, particularly wages, and changes in the level of output will then feed down to the amount of money in existence. So it works backwards. You then get from that stage, that's broad money. You're now looking at what happens to base money and the so-called money multiplier. Well, they are also determined in reverse because, yes, the Reserve Bank controls B, but its main role is to be a lender of last resort, to stop the system breaking down. Incidentally, if you see, there's a piece of great research done by one of the academics at the University of Missouri, Kansas City, whose name I keep on forgetting when I try to quote this paper, which measured the total amount of money the Federal Reserve has created since the crisis began to rescue the economy. Any idea how much it is? 29 trillion. 29 trillion. Now what's actually happening is that most of this money is being created in repo agreements. So the government agrees, the central bank agreed to expand the range of instruments that it would buy. So it wouldn't just buy short-term bonds, it'll buy long-term government bonds. And it buys mortgage-backed securities, and it buys, blah, 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 housing loans, car loan stuff as well. Because they bought them mainly in repo agreements. So you buy with an agreement you buy them now with the agreement to sell them back later, where the difference between the buy and sell price represents a rate of interest, but a very low rate of interest. So they're trying to control the price across the whole yield spectrum of a whole range of bonds. So what you can envisage that like is having a bathtub in which you've got the water going full blast and the plug's not in the hole. So lots of money pouring through, and there'll be a rate of inflow. If you measure the rate of inflow over time, you can say what the total amount of money created was, and there'll be an amount stuck in the bath at any particular point in time, which is what's left over at the moment. So over the period from the beginning of the crisis back in 2008 or late 2007 through to about the beginning of this year, the total amount poured through the bath was $29 trillion. Okay. The amount actually outstanding in the bath at the moment is about $2 trillion. So that's the scale of the rescue they've got into to stop the system breaking down. And this guy's point was, that James, I think is his first name, that imagine how the world would be if they hadn't done that. Because you would have had breakdown in all sorts of markets, collapses in bond prices, etc., etc. So it's the scale of what they've done to really relax all the constraints that they had and to expand base money drastically. The expansion of base money that Bernanke has done is so great that the base money supply M0 took 13 years to double up to when Bernanke began with his quantitative easing. It then doubled in the next 4 months. It went from a doubling rate of every 13 years to a doubling rate of 4 months. That's an idea of the scale of increase in the base money. So this stuff which Basil wrote back in 1979 is well and truly come true now, because he said you have the need for an elastic currency to offset, basic shocks and avoid financial crises. And that's why they formed the Federal Reserve in the first place. So rather than being there as a control mechanism to stop the economy going in the way that the Reserve doesn't want, it's a response mechanism when things really screw up. And of course they have really screwed up big time now. So what it means is causation works backwards there as well. You go from changes in broad money to whatever the government has to do to modify the base money or the money multiplier ratio. Now the money multiplier itself, again, the best critique you can find was somebody inside the system. This is Alan Holmes, who was then the senior vice president of the New York Fed. Now that's the place that Bernanke is now the president of, and therefore the chairman of the Federal Reserve. And he said he was fighting against the whole idea of bringing monetarism, and said the belief that the money supply can be controlled, but look at this line, suffers from the naive assumption that the banking system only expands loans after there have been reserves put into the banking system, which is the money multiplier type argument. And he says, in the real world, banks extend credit, creating deposits in the process, and look for the reserves later. Okay. So it's straight post-Keynesian logic. It's a very, very good paper. And he was fighting a rearguard action to stop them trying monetarism, which he said would fail. Now, what actually Volcker did choked inflation out of the economy. According to monetarism, it should have been a smooth removal of inflation from the economy. So it worked, but in a brutal way rather than with very little impact on the real sector way that monetarists argued would happen. So he said, in the short run, the Federal Reserve has little or no choice about accommodating the demand for funds. If banks need to have extra reserves to settle their own debts with each other, then they have to create it. And notice this one, in any given statement week, the reserves required to be maintained are predetermined by the level of deposits 2 weeks earlier. So it's a lag requirement. Now, what do you reckon the lag is now? That was back in the days before computers, obviously. If you go manual systems. My father was actually involved in the manual settlements in Australia. He was part of the banking group that met between the banks every day to settle their debts internally. And then they had to go, and after that, they had to go and get the reserves. If they were short of reserves, they had 2 weeks to get the reserves, given the amount of over or under they found themselves to be on a daily basis. So that was 2 weeks back in the days of manual systems. How long do you reckon the delay is now? Pardon? A month. Guess what happened? The bank strong-armed the reserve to make it even more relaxed for them. So they've now got a month to get the reserve they need, rather than 2 weeks back in the 1960s. That's how much the banks dominate the system these days. So Basil's argument, bank lending is the cause of change in the level of money, and with lag requirements, once the deposits are created, the central bank has no choice but to make those reserves available. Okay. So rather than reserves being a control mechanism, they're a response mechanism. And the European Central Bank, hardly a bastion of radical thinking you would expect, came out with a paper, this is just published in May 2012. The European Central Bank Bulletin made precisely the same point. I almost think they were writing a sort of, tell Krugman to listen to me about this one. That's being a bit egotistical, but anyway. They were saying that the reserves do not control the amount of money in the European system because we have a lagging requirement. So he said the reserves are determined by deposits issued by the banks in the previous reporting period, and therefore after banks have extended the credit demanded by their customers. Perfect statement of endogenous money in the May 2012 issue of the European Central Bank Bulletin. So this is realism. This is actually how things operate. So, and also excess reserves run at frictional levels. The amount of money actually there is just enough to satisfy the needs for banks to settle accounts with each other. And it's determined in advance. So reserves aren't a control mechanism, they're a response. And they said, therefore, the reserves have to be available. It's got discretion about how it supplies those reserves. So it can do it through the lending window, or people can borrow from each other. But they have to be supplied by a combination of open market operations, the buying and selling the bank actually does, or the movements of reserve factors, or member banks can borrow from the discount window. Now, normally they avoid the latter. There's a bit of embarrassment in doing that. But he said, and this is again Holmes speaking once more, he said, it might be noted the suggestion that open market operations could be used in the short run to prevent a rise in total reserves is completely illogical. There's critiquing the theory of money creation you guys still get in conventional macro courses 50 years later. The reserves have to be there. They have to accommodate it. And this is an excellent paper, again downloadable from the web. So that's why reserves don't control deposits or loans. In fact, deposits and loans control reserves. And again, Basil's arguing here that the primary need that the banks fulfill is providing working capital to firms. That's changed somewhat in the modern system given how Ponzi banks are these days. But that therefore sees a causation running from wages and also from investment to the demand for money. So that's the perspective we're taking you through, and I start developing a more realistic model that credit expands and contracts given the needs of firms and unfortunately also the desire of banks to make money by creating too much debt. So this extension of credit lines is the fundamental mechanism. So if you have and what actually happens, rather than deposits creating loans, it's loans create deposits, and they create them simultaneously. So when you get a new loan, just like the example I gave you about the motorbike earlier, buying the bike also is creating the deposit and creating the loan at the same time. So causation works from prices and transactions to the level of money, from money to the level of base money, and the money supply is determined by what the financial system and the private sector wants rather than what the government wants. And that therefore means that changes in debt have an impact on the macroeconomy. So you've got to include debt in your model of the macroeconomy. That's the basic case, but it reverses completely how we think about capitalism. Rather than having it as a barter system, in which money is just an optional extra that gives you nominal prices, and where it's actually determined outside the economy, you have an inherently monetary economy. You can't model it just by taking a barter system and whacking cash on top of it. So you've got to start with this whole idea of debt being created, and that therefore having impact upon the economy, which would go well beyond just short-run impacts. And it also says that trade is not about consumption. If you think about the orientation you've got in neoclassical macro, it's saying that the whole object of the economy is just to satisfy consumers. Whereas this vision says, no, it's about accumulating wealth in monetary terms. It's also an essential motivation in the capitalist economy. And if you look for where the argument that money is available to barter comes from, it comes from Jean-Baptiste Say, back giving his, Say's law arguments. And notice what he argues here. He says, every producer asks for money only for the purpose of employing that money again immediately in the purchase of another product. So money is transitory, ephemeral thing. We don't consume money. There's no advantage to holding money, in other words, in Say's mind, and we don't seek to conceal it. That's news to me, but anyway, let's keep on going. So producers, in reality, demand goods for their goods. Money is unimportant. That's Say's law. Now, the other approach comes from Marx. And Marx says, well, in fact, this argues that traders don't want money. They just want to exchange. He said, Well, that's true. People actually want to swap what they have and don't want for what they don't have and do want. But he said, therefore, you can say that exchange is a transaction which both sides gain. But he said, but that's not the main game in capitalism. The main gain in capitalism is not improving use value, but expanding surplus value, profit. That's the driving motive of capitalism. And you're kidding yourself if you abstract from that and think it's just about satisfying the consumption needs of the producers, which of course is what neoclassical theory does. And so the ultimate form of wealth is money, accumulated money. That's what capitalism is actually about. And Keynes also satirized the whole thing, because notice this thing saying we don't consume money. That's saying there's no utility to money. Now I saw Nick Rowe, a fairly loudmouthed Canadian neoclassical economist. I call him loudmouth because he's got a bigger mouth than he has eyes, because he's the guy whose misreading of me was communicated to Krugman, that Krugman could misread me in the New York Times. But he then said recently there's no utility to money. Money gives no utility. Well, Keynes said it gives you the utility of security in an uncertain world. And he satirized the conventional view, saying money, how do conventional people talk about money? They say, well, you use it as a unit of account, and you also use it to store wealth. But he then said, why would you store wealth in the classical world? Because in the classical world, any other way of holding your wealth gives you a yield, or if you hold money, you get no yield. Why should anybody outside a lunatic asylum use money as a store of wealth? And this is a beautifully put sentence, the sort of stuff Keynes can write when he's absolutely on his game. Because partly unreasonable and partly on instinctive grounds, our desire to hold money as a store of wealth is a barometer of the degree of our distrust of our own calculations and conventions concerning the future. So the utility money gives you, it's a hedge there in case your expectations don't turn out to be correct, which of course is almost certainly going to happen. So money is something very, very different to commodities too. The neoclassical will say you can just hoard commodities in that case. Well, you can always hoard the wrong commodity. But if you hoard money, unless you've got a total breakdown in society, then you can use that money later. And again, the different view of money being created by loans rather than deposits creating loans in reverse. So what you get from this vision, and I'm going to be systematizing this in the next couple of weeks. Incidentally, when I first gave this subject about 6 years ago, all I had was this diagram and the very beginnings of a monetary argument. I didn't have a mathematical model. So courtesy of teaching your predecessors, I've built the models I'll be showing you in the next few weeks, including the software package that goes with it. But this vision says you start from having a banking sector that simply exists to create loans. The banking sector only makes money if they create, or makes a profit if they create debt. And then they profit on the gap between the cost of money and what they can make up by lending it out. So you have a firm that wants money, say $100 million, approaches the banking sector, which gives them the loan. Now that then means that there's $100 million in the credit account for the firm and a matching $100 million in the asset side of the bank. So it's, again, bank balanced assets and liabilities. But that money has been spent over time by the firm, which then means it goes, the people who supply then deposit money, get in the bank and back in bank accounts, and then that bank money goes back up to the economy and it continues circulating. So you get an initial creation of money coming out of it. And the creation of credit comes out of the banking sector itself. The government does it independently, but often in response to what happens in the private sector, and they both end up being stored in private bank accounts. What the government's trying to do is control the ratio between the two by setting targets or by the Basel Accords. But primarily, credit money is driving base money, as we've seen very, very emphatically in the last few years. And I'll start taking you through all that stuff after I get back from New Zealand again next week.